Welcome back. Well, as promised, let's straight away go across to Vaibhav Sanghvi. He's joining in, CEO of ASK Hedge Solutions. Vaibhav, great to have you with us. I mean, never a dull moment in the markets, right? And just so much going on, from trade to geopolitics to a full-fledged war we had almost at our hand, right? So what's the sense? I mean, the market got the twin bonanza, the great news of at least, an end to hostilities right now between India and Pakistan. Then we had the news on the China deal, China-US. So there was a quick reaction. But the worry that I had, and that's what I wanted to ask you, I was discussing this at the start of the show, is that tactically, it seems there's a shift towards China, right? We don't know how long it lasts or not, but it's very evident in the way the markets have been reacting last 2-3 days. Is this potentially a risk in terms of flows and the large cap performance for India in the near term?
Absolutely right, Sylvia. I think because of the announcement of a 90-day period for the trade deal to be negotiated, in my sense, I think there is some amount of preference or some amount of reshuffling happening towards China. Doesn't mean that it is completely going from India, but on an overall basis, what do I think is basically that if the overall flow is coming to China or probably emerging markets as a basket, then India would be a beneficiary of that flow in any case. Of course, if it's not coming to an emerging market basket, then probably there is some amount of reshuffle towards China. But in my view, I think as things have steadied and as things appear to be on the constructive path, my sense is basically that emerging market flow on an overall basis, will start increasing. And there is a correlation that, whenever China sees a good amount of interest in terms of the flows, doesn't necessarily mean that it is coming from the other emerging markets, but it is actually coming towards a whole basket, wherein India tends to be benefited.
Okay, so perhaps we need to see how the flow situation plays out. But otherwise, Vaibhav, let's leave that aside. I mean, that's a flow situation, tactical. We'll see what it brings. Otherwise, how do you rate the earnings season? And now that like I said, we've had the two good news pieces. Markets bounced back very smartly. We're some 4.5%, 5% away from the all-time highs. How do you see the next 6 months?
No, of course, the macro events, which were headwinds, from a market perspective, are now behind. One, of course, the tariffs, and the two is the geopolitics. And it is a situation where markets will start looking at earnings, valuations closely. Having said that, this earnings season, barring one or two sectors, I think the earnings have been pretty decent and a little marginally higher than the expected kind of run rates. What do we also expect is basically going through the year, that a combination approach of combined effort, both from the fiscal side in terms of tax rebates, which we have already seen, and two, from a loose monetary policy in terms of liquidity being better, rates decreased, and risk weights kind of taken off from the unsecured piece in some segments. My sense is basically, I think we will see revival or probably GDP growth surprising, on the higher side as against your, street expectations, which is where we do think that in the second half of this year, we may see some amount of revival of earnings also starting to happen.
Okay, all right. Hi, Vaibhav. I wanted to ask you about the defense space, because from everyone quizzing about how expensive these stocks are, now everyone is asking, what's your allocation to the defense stocks? I'm going to come and ask you that question itself. For the time being, though, let's hop across to my colleague, Ria, who's here to tell us about Garden Reach Shipbuilders as well as HAL. Both of them are buzzing post their numbers. Ria?
Well, yes, defense and shipbuilding stocks have been in focus yet again today, and let's talk about the three big movers. The first one is Garden Reach Shipbuilders, which reported quite a healthy set of numbers yesterday. The revenue saw an increase of around 62% on a year-on-year basis. Even the EBITDA and net profit jumped up by 144% and 119% respectively, both on a year-on-year basis. EBITDA margins also saw an expansion of 454 basis points, coming in at 13.5% in this quarter versus just about 8.9% that we saw in Q4 of last year. For the full year FY25 as well, we've seen good growth on all fronts. The net profit margin was also above the company's guidance of over 8%. The order book details haven't been disclosed yet, but the company did say in their Q3 earnings call that they expect the order book to come down to about 22,000 odd crores as execution is picking up, and the order book at the end of Q3 stood at about rupees 23,877 crores. Some key things to watch out for GRSE going ahead will be the management's comments on order book and execution, and also an update on the delivery delivery of one of their key projects, which is the 8 ASW shallow watercrafts, all of which are expected to be delivered by October 2026. And remember, the first ship was delivered by the company to the Indian Navy just last week. The stock is trading with gains, very strong gains of around 17 to 18% today, but still down about 20% off its 52-week high. Cochin Shipyard is also trading with gains of up to 13% today in a rub-off effect from GRSE, and this company is also expected to come out with a good set of numbers tomorrow, so we will be watching out for that. HAL is the third stock that we'll be talking about, up around 3 to 4% after reporting a good set of numbers today. The revenue did go down by around 7.2% on a year-on-year basis, but this was off a high base. The net profit and EBITDA also declined by around 10% and 7.8%, but they were significantly higher than our estimates. EBITDA margins came in at 38.6%, down about 129 basis points on a year-on-year basis, but still well above our expectations of 27.6% margins. Order book details again haven't been disclosed for HAL, but they do have an FY26 order book target of about rupees 2.6 lakh crores. Some key things to watch out for in the earnings call on Friday will be the management's comments on the LCA Mark 1A delivery timelines and further engine deliveries from General Electric, improvement in working capital execution schedule of ALH, and of course the management's comments on the order book and execution ahead.
Hey, thanks a lot for that, Ria. Vaibhav, that's the question. What's the allocation to defense? You know, what this recent skirmish has showed is that this equipment is battle ready. India is focusing more on indigenizing the defense equipment here in India. And as our defense minister said, that the exports of defense equipment from India to the globe can reach 50,000 crores by 2030. How interested are you in this space?
I think I am hugely excited about it. And, I think what India has shown to the world, and with some sense of pride also, I can say that I think it is, what India has achieved in terms of defense production, in terms of technology, I think it's just outstanding. What we've seen is probably an inflection point for the defense exports likely to happen from India. In my view, I think the order books are likely to balloon. And what better way in terms of showing the product performance in that sense of what we've seen in the last week. So in my view, I think it's a much of a very long-term story here now. I'm not talking about a shorter-term perspective, but the order books, in my view, are likely to swell or balloon pretty quickly going forward.
Okay, so I mean, you still see some value given the fact that there's growth ahead in defense. That's right, Vaibhav?
Of course, because here it is very difficult to put a PE valuation matrix here in the light that when your order books are going to exponentially rise or likely to exponentially rise from various other countries. My sense is this opportunity will be captured by our public companies which are doing some excellent work.
Sure. Okay, so that's one clear theme. Defense, you think, still has some more legs to run. What else, Vaibhav? Because this market doesn't have too many growth ideas, right? Clear growth ideas. Large sectors are still struggling in single digits or mid-single digits. What else are you liking?
So I think one difference which I did mention earlier is basically one of the bigger headwinds, from the global perspective, which is your tariff-related stuff, I think has kind of eased off. And any incremental news regarding that is not kind of having an impact on the margins or impact, on the sentiment of the markets. What we do see is because of this, the overall worry of IT discretionary spend, which are likely to kind of get suppressed because people didn't understand, how the situation is likely to pan out. I think now it is very, very clear that deal will be done, whether it is a matter of 1 month, 3 months, or 6 months. So all in all, I think the confidence of the companies to do business, to expand, to spend on IT is likely to come back. In the way that I think IT as a sector, we've seen good correction in terms of the valuations. My sense is basically, I think we should be looking at as a good opportunity from here onwards to kind of invest in. Lastly, I think because of the rate movements, likely rate movements, there can be a shorter term pressure on the banks just for the sake of worries in terms of the rate kind of gets reduced, then probably there can be some amount of margin pressures on the NIMs. So we'll wait for the bank rate cut to happen to probably get into the frontline private banks post thereon.
Okay. All right, Vaibhav, got that. Good perspective. Thank you very much for joining in today. And we look forward to the next call soon. Thanks for joining in. Well, with that.